Good morning, everyone, and welcome to the webinar, The Revised EBA Money Laundering and Terrorist Financing Risk Factors Guidelines, what each financial institution needs to know. Thank you for taking the time to be here. In this webinar, we will talk about the ins and the outs of these revised EBA guidelines, which were published earlier this year and will apply from October 7, 2021. A lot of the changes will be conducive to the implementation by financial institutions of a more effective risk-based approach to AML CFT. In today's session, we want to help you better understand what the EBA risk factors guidelines are, how they apply to your organization, and what your firm can do to comply with these guidelines. After this short introduction, let's get started with the webinar. Our speakers for today are Pierre Simon and Daria Patrascoiu.
Yes, good afternoon to all, and welcome to the webinar. Let me shortly introduce myself. So my name is Pierre Simon. I have been in this profession for over 20 years already, where I initially started my career as a police officer back in Aruba. And I've been working the last couple of 20 years in the financial sector, mostly in the Netherlands. I have a background in Dutch law, where I studied at a Free University in Amsterdam. And I've specialized mostly in financial crime compliance. And also I am a certified auditor for the compliance management ISO standards. Maybe also nice to mention, I was nominated for the National Compliance Award in the Netherlands in 2017. And besides that, I have been providing training on different topics, including AML, CFT, and other financial crime topics. And I've been linked as an external trainer to the Netherlands Compliance Institute.
Thank you, Pierre. Hi, everyone. I would also like to welcome you and to thank you for participating in today's webinar. My name is Daria. I am a Romanian qualified junior lawyer, and I have a bachelor in law at University of Bucharest. And after graduating, I have moved to the Netherlands, where I have finished my master's of law in investment law. I also have a working background in banking and finance before I've started my journey in compliance 7 months ago when I have joined Simon Consulting. I hope that you will enjoy today's webinar. And to get started, we will look a little bit at the program for today's webinar, which will be split into 3 parts. First, we will discuss what exactly are the money laundering and terrorist financing risk factor guidelines. Second, we will look at how do they apply to your organization. And third, what can you do to comply with these guidelines. And ultimately, we will also have a Q&A at the end. Now I'll give the floor to Pierre to start the first part of our webinar.
Yes, thank you, Daria. I think the main question, of course, of today is what are the EBA guidelines? So for the next 10 minutes or so, I will try to answer the question of what exactly are the revised MLTF risk factor guidelines. So as is now very common with regulatory guidelines, a version of these revised guidelines was publicly consulted last year in 2020, and the consultation paper included a number of specific questions for respondents to consider. In total, the EBA received over 50 responses submitted by a wide range of financial sector participants, including supervisory authorities, credit institutions, payment initiation service providers, and so on. These responses covered areas such as business-wide risk assessment, non-face-to-face interactions, financial inclusion and de-risking, and many other topics. But before we can dive further into these revised money laundering and terrorist financing risk factor guidelines, we must, however, first understand what the EBA is. So the EBA stands for the European Banking Authority, which is an independent EU authority established in Paris and was formed back in 2011. They have a mandate to protect the integrity and orderly functioning of the banking sector in Europe. It does this by drawing up technical standards, guidelines, and recommendations for the banking sector. Since January 2020, the EBA has been solely responsible for leading, coordinating, and monitoring AML CFT efforts across the entire EU financial sector. After a build-up phase in recent months, a standalone AML CFT unit, which is headed by Caroline Gardner, has been created to carry out the new tasks conferred to the EBA as of the 1st of January 2020. So let's have a closer look at the guidelines, at least the structure of these guidelines. So as you can see, these guidelines come in two parts. Title I contains the so-called general guidelines that are applicable to all firms, for instance, banks and financial institutions. Title II is sector-specific. And the sector-specific guidelines of Title II, which will be discussed in the second part of this webinar, are incomplete on their own and should be read in conjunction with Title I. Let's now have a deeper dive into Title I, the general guidelines, and more specifically into Guideline 1, which is about the key principles of conducting risk assessments. So Guideline 1 contains 6 key principles: general considerations, keeping risk assessments up to date, business-wide risk assessments, linking the business-wide and individual risk assessments, and finally, the sources of information. So let's have a look at the first key principle, general considerations. As you most probably already know, that to be able to comply with your obligations in the EU AML directive, your firm should assess the money laundering and terrorist financing risks to which it is exposed as a result of the nature and complexity of your business, better known as the business-wide risk assessment, and entering into a business relationship or carrying out an occasional transaction, which is better known as an individual risk assessment or customer risk assessment. When assessing the overall or residual money laundering terrorist financing risks, you should consider firstly the level of inherent risk, secondly the quality of controls, and finally other risk mitigating factors. When we talk about quality of controls, the EBA's biannual opinion on the MLTF risks affecting the EU's financial sector, of which the EBA is mandated to issue, is definitely a must-read. The opinion highlights ongoing concerns by competent authorities across the EU about firms' identification, but also assessment of both business-wide risks and the risk associated with individual business relationships. And finally, the application of CDD measures. According to this opinion, the quality of controls of credit institutions in 2018 have been assessed as follows. Effectiveness of ongoing monitoring. Over 40% of the firms which have been assessed by competent authorities scored poor. Effectiveness of STR, or suspicious transaction reporting. 32% of the firms scored poor. And finally, quality of customer risk assessments. Also 32% of the respondents of the firms scored poor. To stay on the topic of risk assessments, Guideline 1.6 states that firms should put in place systems and controls to keep their assessments of the money laundering and terrorist financing risks associated with their business, but also with their individual relationships under review to ensure that their assessment of the risks remain up to date. More specific, the systems and controls that firms should put in place to ensure their individual and business-wide risk assessments remain up to date should include setting up a date for each calendar year on which the next risk assessment update will take place, and setting a date on a risk-sensitive basis for the individual risk assessments to ensure that new or emerging risks are included. Where you become aware that the date that a new specific risk emerge or an existing one has increased, this should be reflected in your individual and business-wide risk assessment as soon as possible. Also, you should carefully record issues throughout a relevant period that could have a bearing on the risk assessments, such as an internal suspicious transaction report, compliance failures, and intelligence from front office staff. Now, what are the key principles in relation to the business-wide risk assessments? First, you should ensure that your business-wide risk assessment is tailored to your business profile, and also take into account the factors and risks specific to your firm's business. So whether or not your firm draws up its own business-wide risk assessment or not, or contracts an external party to draw up its business-wide risk assessment, the firm still stays end responsible. And finally, be aware, however, that the generic risk assessment that has not been adapted to the specific needs and business model of your firm, so-called off-the-shelf risk assessment, or a group-wide assessment that is applied without questioning, is unlikely to meet the requirements of Article 8 of the AML Directive. Next, you should use the findings of your business-wide risk assessment to inform your AML CFT policies, but also the controls and procedures. And to comply with Guideline 1.18, you should use your business-wide risk assessment to inform the level of initial customer due diligence that you will apply in specific situations and the particular types of customers, products, services, and delivery channels. Note that individual risk assessments should inform, but are no substitute for a business-wide risk assessment. Individual risk assessments are also known as customer risk assessments. When conducting these specific customer risk assessments, you should consider relevant risk factors, including who your customer is, the countries or geographical areas they operate in, the particular products, services, and transactions the customer requires, and finally, the channels used to deliver these products, services, and transactions. The final key principle in Guideline 1 focuses on sources of information. Looking more closely at Guideline 1.29, this specific guideline states that to identify your money laundering or terrorist financing risk, you should refer to information from a variety of sources. These can be assessed individually or through commercially available tools or databases that pull information from several sources. Some examples of sources of information that you must always consider are the European Commission's Supranational Risk Assessment, the European Commission's list of high-risk third countries, and information from governments, such as, for instance, governments' national risk assessments. So moving on to guideline number 2, which focuses on identifying money laundering and terrorist financing risk factors. So guideline 2 contains a total of 56 different risk factors applicable to all firms, which are grouped together in 12 different risk labels and also 4 different risk factor categories. This guideline is one of the most important guidelines in my opinion, since it focuses on the core of AML risk management, being the risk factors that needs to be identified. Guideline 2 contains a total of 32 customer risk factors, which have been further divided into 3 different types or labels. These specific labels are mentioned in Guideline 2.3, which states that when identifying the risk associated with their customers, including their customers' beneficial owners, firms should consider the risks related to the customers and the customers' beneficial owners' business or professional activity. Secondly, the reputation. And finally, the nature and behavior, including whether this could point to increased terrorist financing risk. Moving on to the countries and geographical risk areas. 11 countries and geographical risk factors have been further divided into the following 3 different labels. Firstly, the jurisdictions in which the customer is based or is resident, and in which the beneficial owner is resident. Secondly, the jurisdictions that are customers and the beneficial owner's main places of business. And thirdly, jurisdictions to which the customer and the beneficial owner have relevant personal or business links or financial or legal interests. One concrete example of a risk factor that should be considered when identifying the country risks is the level of transparency and tax compliance. And more specifically, the observation that the jurisdiction is not committed to and has not effectively implemented the Common Reporting Standard, or the CRS, which the G20 adopted back in 2014. Moving on to products, services, and transaction risk factors. When identifying the risk associated with your firm's products, services, or transactions, you should consider the risks related to the level of transparency or opaqueness that a product, service, or transaction affords. Secondly, the complexity of the product, service, or transaction. And finally, the value or size of the product, service, or transaction. In regards to complexity, you should, for instance, ask yourself the question, does your firm understand the risks associated with its new or innovative products or services? In particular, where this involves the use of new technologies, for instance, blockchain, or innovative payment methods. And then looking at a final risk factor category in Guideline 2, which is the delivery channel risk factors. Guideline 2.20 states that when identifying the delivery channel risks, you should consider the risk related to the extent to which the business relationship is conducted on a non-face-to-face basis, but also any introducers or intermediaries the firm might use and the nature of the relationship with the firm. But when assessing the delivery channel risk, you should consider a number of factors, 6 in total, including whether the customer is physically present for identification purposes. If they are not, whether your firm uses a reliable form of non-face-to-face CDD and takes steps to prevent impersonation or identity fraud. Now, the last 3 general guidelines contain specific requirements related to record keeping, training, and reviewing effectiveness. Let's have a look now at Guideline 6, which is about training, and Guideline 7, which is about the periodic review of the effectiveness of your AML approach. So, Guideline 6, training, is a short but nevertheless very important guideline, containing only 3 requirements. I want to highlight, however, Guideline 6.3 states that you should ensure that AML CFT training is relevant to your firm and its business, is tailored to staff and their specific roles, and is updated regularly and is effective. And trust me, tailoring training to staff and their specific needs, it's not an easy task. And then finally, Guideline number 7, reviewing effectiveness. This is an even shorter guideline, containing only 2 requirements. The highlighted newly introduced Guideline 7.2 states that you should consider whether an independent review of your approach may be warranted or required. The EBA noted here that firms must ensure that their approach to AML CFT is effective and in line with applicable legal and regulatory obligations. This means that you should consider whether an independent effectiveness review of your AML CFT systems and controls is actually needed, and if it's needed, what its scope should be. The review should take place on all or some of your policies, controls, and procedures, and could be done either internally or externally. In any case, you should be able to justify your approach to your competent authority.
Now we will move to the second part, and after we've discussed the general aspects of the guidelines, we'll look now at how do they apply to your organization, and more specifically what I will be discussing in this part is the sector-specific guidelines, which are provided in part 2 of the document. The first 5, so in total there are 13 sector-specific guidelines, and if you look at the first 5, we have for correspondent relationships, for retail banks, for electronic money issuers, for money remitters, and for wealth management. First, just to point out, all of these guidelines have the same structure. So first, they lay out the risk factors, which are specific to every sector, and then the measures that should be taken in place for such if the risk factor is relevant and if such a situation occurs in your day-to-day activity. Now, if we take a closer look at guideline number 10, this one provides the relevant information for electronic money issuers as defined in Article 2.3 of the e-money directive. And according to the EBA's Public Register of Payment and Electronic Money Institutions, there are currently 279 institutions that are active and authorized or registered to issue, distribute, and redeem electronic money in the economic area, out of which 236 are e-money institutions and 43 are exempted e-money institutions. What's also important to mention is that firms whose authorization includes the provision of business activities as payment initiation services and account information services, or have also activity of money remittance, should also keep in mind Guideline 11 and Guideline 18. And also something that is applicable for the whole document in general of the EBA guidelines is the relation between the countries and the EBA guidelines, and how exactly do these guidelines get to be applied. what's important to mention is that every country gets to decide whether or not they will be in compliance. Some countries are complying at the moment with the guidelines, such as Slovenia or Ireland. Others have stated that they will be partially complying or not complying, such as Sweden, and countries such as Romania, which have stated that they have the intention to comply, and that the financial supervisor is currently preparing the revision of the local guidelines. However, with this specific example of Romania, there are some other issues of implementation, because before we even get to speak about compliance and complying with the EBA guidelines, the problem in Romania is that currently there are only 3 e-money issuers which are authorized by the National Bank, and the number of money issuers that are providing the service and that are requiring that do want to be authorized is increasingly is increasing. And the bureaucratic process is not getting any easier, so therefore their authorization process in itself is hindered, and more attention is put on this side rather than on complying with international guidelines and with other relevant other relevant documents. Looking forward, as I mentioned, every guideline has the same structure, so they present the risk factors and the measures. And for example, if we look here for guideline number 10, we have product risk factors, we have customer risk factors, distribution channel, and country or geographical risk factor. For example, if we look at product risk factors, we can identify the funding method of the issuer, and the risk of money laundering is increased in a situation where the product can be loaded anonymously with cash or funded by an unidentified third party. This is important because in these kind of situations, you might trigger the need for enhanced due diligence. So every situation will have to be analyzed and decided whether or not what type of customer diligence you will need and what kind of control measures you will need. In this situation, it might be enhanced due diligence. In other situations, only simplified due diligence might be enough. Because as we see in the highlights, the level of risk depends primarily on the features of the products, and you should always consider the sector-specific risk factors and the appropriate measures present in these guidelines. Now, also on this industry, if we look at some interesting stats, also from the EBA's opinion on the risks of money laundering and terrorist financing from 2021, where we can see here 2 graphs that compare the situation in 2018 and 2019 when it comes to the quality of controls. And basically, why do we need for companies to comply with this document, and in general to keep in mind guidance documents? As we can see, the quality of controls has actually decreased from 2018 to 2019. And if we look at the main points of interest, which are business risk assessment and customer risk assessment, we see an increase when it comes to quality of control being poor, from 33% to 39% on business-wide risk assessment, and from 39 to 42 when it comes to customer risk assessment. Now, if we move on and we look at another graph of this opinion, which shows the common breaches, if we look at the same points of interest on risk assessment, once again, we see that there has been an increase when it comes to business-wide risk assessment and customer risk assessment from 2018 to 2019. Now, if we move forward, and if we quickly enumerate the remaining sectors, we have trade finance providers, life insurance undertakings, investment firms, providers of investment funds, crowdfunding, and the last 3 being payment initiation service providers, account information service providers, currency exchange offices, and corporate finance. So if your company is part of any of these sectors, then it would be good to keep in mind these guidelines and to look forward to see what are the specific risk factors and control measures. Now, if we also focus a little bit on guideline 18, since this received the most questions and need for clarification in the consultation period that Pierre mentioned earlier, that this document has been proposed and consultation has been requested. And some of the people that have proposed modifications or have asked for clarification asked if the payment initiation service providers and account information service providers are obliged entities under the AML directive. And the EBA highlights that EU law does define these entities as obliged entities under Article 2 of the AML directive. Once again, we think that this also, given our audience, we believe that this is an important guideline to put a little bit more focus on. So first of all, some interesting information. First, according to the EBA's public register of payment and electronic money institutions, there are currently already 294 institutions that are active and authorized or registered to provide these services, out of which 168 are payment institutions, 47 are electronic money institutions, and 79 are account information service providers. If we look at the highlights of this guideline, it is important to mention that even though, as we discussed, they are obliged entities, the inherent risk of money laundering is generally limited. But however, as part of the CDD process, the providers should always ensure that their systems properly alert unusual or suspicious transactions, and that they have their own third-party typologies for detecting these transactions. This is a very important element, since the activity is always done online. And mostly because CDD is such an important part of the control measures, the providers need to make sure that all the data that is stored with the explicit consent of the user. The applicable risk factors are customer, distribution channel, and country or geographical. If we look at a few relevant examples that might also trigger enhanced due diligence and that are increased in risk, first, we can look at customer risk factors and the situation where, for example, the customer transfers funds from different payment accounts to the same payee, or the other way around, when he receives funds on different accounts from the same payee. Or from the perspective of the last risk factor, which is country or geographical risk factor, where a customer, for example, initiates payment to a jurisdiction that is considered a high-risk third country under the standards of the European Commission or the FATF. And this situation should always raise a big red flag and need to be assessed individually, checking the guidelines as well, and deciding what type of due diligence will be needed and what kind of actions will be required. Now, let's look at another interesting statistic also on the point of quality controls when it comes to guideline 18. We see here again, we analyze on the right side in 2019 the quality of control, and we see that once again it is qualified as poor for 48% when we discuss about the most important points of interest, the business-wide risk assessment and customer risk assessment. And on the right side, we also see the top 3 most commonly identified breaches in 2019, which are internal controls and overall anti-money laundering and counter-terrorist financing policies, customer identification and verification, and beneficial ownership. Now, these were in short a few relevant details about the sector-specific guidelines and an overview of the information that can be found in them. which we believe that it's very important when constructing your compliance program, especially if you are part of one of these 13 sectors. Now, if we move on at the last section of our webinar, we pose another important question, which is, what can you do to comply with these guidelines?
Yes, thanks, Daria. So indeed, the final question of this webinar, what can you actually do to comply with these guidelines? Well, in today's webinar, we try to help you better understand what the EBA MLTF risk factor guidelines are, how they apply to your organization, and what your firm can actually do to comply with these guidelines, but also the factors that you must take into account when assessing money laundering or terrorist financing risks connected to your business relationship or an incidental transaction. These numbers that we see here, it's good to mention that the revised money laundering terrorist financing risk factors contains a total of 56 general and 239 sector-specific risk factors, out of which over 100 new risk factors in the newly added guidelines, 17, 18, 19, and 20 alone. The guidelines are applicable to almost 110,000 institutions in Europe. So you can imagine the extremely large impact of these guidelines. And although they're not mandatory per se, these guidelines help firms in Europe, but also firms that are active outside of Europe that are dealing, for instance, through a correspondent banking relationship with European banks, to also comply with their own local AML CFT requirements. So as we highlighted today, there are two sets of requirements that are relevant when conducting business-wide risk assessments, which are proportionality and implementation. Looking a little bit closely at proportionality, so as set out in Article 8 of the 4th AML Directive, the steps that every firm should take to identify and assess money laundering and terrorist financing risk across their business must be proportionate to their nature and size. Small firms that do not offer complex products or services and that have limited or purely domestic exposure may not need a complex or sophisticated risk assessment. Looking at implementation, to implement the requirements of these guidelines, firms should make their business-wide risk assessment available to competent authorities, regulators, take steps to ensure that staff understands the business-wide risk assessment and how it affects their daily work in line with Article 46 of the AML Directive. But also to inform senior management about the results of your business-wide risk assessment and ensure that senior management is provided with sufficient information to understand and take a view on the risk to which the business is exposed. So I want to conclude this webinar with the following. Of particular concern at credit institutions, banks, but also other financial institutions are the quality of business-wide MLTF risk assessments, but also the effectiveness of suspicious transaction reporting and the effectiveness of ongoing policies and procedures, including transaction monitoring. These controls were rated as poor or very poor by a number of competent authorities in Europe. Some recommendations. So to be able to comply with these guidelines, we highly recommend the following. First, to review your internal policies and controls, for instance, by conducting a comprehensive gap analysis against these refined guidelines. Secondly, to make necessary adjustments to reflect these guidelines as soon as possible, but no later than the end of the year, and train your staff accordingly.
As a last point to build on what Pierre said regarding training your staff, it's important for us, training in general and knowledge sharing is very important for us, and making sure that the industry professionals are always informed on what they have to do. And in light of also what we've discussed today, we've also launched our own e-learning course and followed by some trainings on risk assessment fundamentals and later on also on the more practical aspects. For more information, you can also go visit our website or visit our LinkedIn page, where we will also share more details about our training and about the following events. Thank you everyone for following us through our presentation. And now, if you have any questions, we give the floor to you. Or you can also write them in the chat, whatever is more comfortable.
Will the presentation be available online?
Yes, we have a recording of this webinar, which will be shared with all of you.
Okay, thank you.
Okay, we have some questions coming in. Looking at the first from Peter van den Akker. To which extent does the business-wide risk assessment differ from the CIRA? I think that's a good question. The term CIRA is used solely in the Netherlands currently, systematic integrity risk analysis. And the business-wide risk assessment, as highlighted in these guidelines, they refer basically to the same. The only difference is that the CIRA, as is applicable in the Netherlands, has a broader scope than only AML CFT. It also covers other integrity risks. But basically speaking, it's the same. And if you look also at the guidelines from the Dutch Central Bank, you can see a lot of similarities in what is also required from a guideline perspective. Okay, we got another interesting question. Can targeted financial sanctions be included in the client risk assessment? Daria, would you like to take that one, or shall I take it?
If you can take it from me.
Yeah, I think this is a very good question. The scope of these guidelines are limited to AML and CFT. So the scope is not sanctions compliance. But of course, as AML professionals, we know that sanction is closely linked to AML CFT. So targeted financial sanctions indeed fall in scope also of client risk assessment. If the customer itself is targeted or is sanctioned, or a country where the client is located is also sanctioned, or the sector, then that's also a relevant risk factor to consider when conducting the risk assessment. No, and I think also feel free if there are any questions also after the webinar that pops up. We're always available to answer your questions. Feel free to just contact us. There's a final one. How far does the risk assessment needs to be updated? Yeah, I think looking at the guidelines, what is recommended from a guideline perspective is that it needs to be periodically updated. And even if there is a trigger, for instance, and I'm talking here about the business-wide risk assessment, I will focus on customer risk assessment as well. Business-wide risk assessment needs to be conducted periodically. It's recommendable, but that's not specified in the guidelines, to do that at least once a year. But of course, whenever there is a change of risk, or there's a change in the structure of your firm, or any new risks coming in, that can also be a reason to conduct a new business-wide risk assessment. Focusing on customer risk assessment, of course, it's already a part of the AML directive and local AML legislation that, of course, you need to conduct periodic reviews depending on the risk profile of the client, but also whenever there is a specific trigger, event-driven reviews also needs to be conducted. So the basic rule is whenever there is a change or a potential change of the risk profile, that should lead to a customer risk assessment.
Okay, we have more questions.
Yes, we have a lot of questions coming in now. Next one, what is the estimated time for financial institutions to apply these changes? Daria?
Well, from an EBA perspective, there's not a specific time allocated for private institutions, given that the main relation is being done between the countries with EBA, which then adopt these guidelines into their local guidelines. So I think it's a matter of every country deciding how exactly are they going to impose this, if they are going to make them mandatory, or if they're going to just remain at the level of guidelines also for the national private institutions. Also, I see another question. this is also applicable to a recent change in the business plan. I suppose this is referring to what Pierre said regarding the revising periodically of the risk assessment. And I think that's the answer is that that's debatable. It's mostly you should be cautious if the change, if you think the change in the business plan also includes any money laundering changes in the policies or in the business activities. I think it mostly depends on every situation, and that should be analyzed and then make an assessment if the revising of the risk assessment is also necessary.
Exactly. Yeah. And I think also good to mention here is that the change of a business plan itself is not per se a reason to conduct a business-wide risk assessment. Yeah. But it all depends on the different factors, right? If the business plan, the change of the business plan leads to new activities in high-risk countries, for instance, or offering higher risk products, then definitely that should trigger a business-wide risk assessment. There's also another question, which is a very good one. Is there a possibility for the EBA guidelines to apply to non-financial services industry, for example, real estate industry? This is a very good question. The current scope, that's because the EBA focuses on the banking sector, including banking services provided by more fintech-like companies, like payment institutions. So the scope is limited also in their guidelines to that specific sector. But if you read all these different risk factors and measures which have been provided in this document, there are a lot of similarities also with other obliged entities, regulated entities. So I would say the scope, although the scope is limited to credit institutions and financial institutions, it is definitely recommendable to, as a non-financial services industry, to also have a look at these guidelines. So I think those were the questions for today. As I already mentioned, if there are any other questions, feel free to contact us after the webinar. We will be happy to answer any questions.
Right. Thank you, Pierre and Daria, and thank you everyone for attending today's webinar. On behalf of Simon Consulting and our presenters, thank you for joining us today and have a great rest of your day.
Thank you everyone for attending.